Hi friends, welcome back to Murthy Finance Academy. Today we will discuss about fast fashion retailing sector companies. The first company today we are going to discuss is V2 Retail. So V2 Retail is not just a clothing chain. It is a clean slate resurrection. For those who remember the 2011 collapse of the Vishal Megamart brand due to logistical sprawl and crushing debt, V2 represents a lesson learned. Management has pivoted away from the over-leveraged errors of the past, focusing instead on a cluster-based asset-light model. The target is the neo-middle class in Tier 2 and Tier 3 cities, a demographic that is graduated from local markets but remains hyper price sensitive. By saturating specific geographies like Bihar and UP, V2 achieves logistical efficiencies that national giants struggle to match. So, the company's store count is, as of December 2025, is nearly 295 stores present in 25 states. And revenue mix, if you see, the company's majority revenue comes from 41% from menswear and 27 from ladies wear. So V2's competitive edge is its value and variety hybrid. They manage a rock bottom average selling price of 363 rupees while maintaining 92% full price sales. A feed that suggests they understand their customers' wallet better than the metropolitan heavy chains. This positioning creates a stickiness that insulates them from the entry level e commerce threat. This model thrives because provincial India is currently seeing a massive shift from unorganized mandis to organized retail. In value retail, geography is the only note that matters. While national players like Trent, which operates Zudio stores, and Aditya Birla, which operates Pantaloon stores, fight for high rental mall space, V2 is digging deep into Bharat. The Indian value fashion market is no longer a niche. According to some industry report from CRISIL and IBF, suggests that segment is poised to reach 170 billion by 2030, with tier 2 and 3 cities contributing over 60% of that growth. The competitive landscape is bifurcated. On one side, you have Zudio, which is a formidable volume machine. On the other hand, thousands of unorganized local shops. V2 occupies the sweet spot in the middle. While the street worries about the new labor code, management's current assessment is that the impact is non-material. However, the retail headwind is not regulation. It's the hyper-aggressive store rollouts from competitors. V2's strategy of deepening penetration in the North Bharat like Bihar and UP is a defensive necessity to prevent Zudio from eating their lunch. In retail, store count is the leading indicator of revenue, but a lagging indicator of profitability. You can buy the top line growth by opening doors, but the bottom line only follows once those stores mature. V2 is currently in a state of hyper expansion, opening 106 stores in 9 months fiscal year 2026 alone. So, if you see the state-wise footprint, it is having a high presence of 20 plus stores, where in Uttar Pradesh it is having 50, in Bihar 48, Odisha 32, and Madhya Pradesh 22, Jharkhand 20, and Karnataka with 20 stores. In growing markets like Assam, it is having 19 stores, in West Bengal 13, Punjab 11, Delhi 10. In presence in Goa with 2 stores and Tripura with 1 store. So the logic of saturating Bihar 48 and UP 50 is about cluster-based logistical savings. Don't be fooled by the store count in Goa. The money is made in the north, where supply chain is dense. Regarding the revenue mix, 41% contributes from menswear, is a stability play. Men buy for utility, ensuring high inventory turnover. However, the 27% ladies wear is the real margin lever. If V2 can push ladies wear towards 35% of the total revenue mix, we will see significant margin expansion due to higher impulse driven pricing power. So, investors must distinguish between operational muscle and accounting driven gains in this quarter. The headline PAT growth is spectacular, but we need a surgical look. So, if you see in Q3 fiscal 2026, the company generated revenue nearly of 929.2 crores with a 57% year-on-year growth, and EBITDA 173.7 crores with 18.7% growth, and in PAT, which stood at 102.1 crores with a 99% year-on-year growth. So the 99% PAT is a noisy number. It includes a 27.69 crores exceptional gain from lease and reassessment, which is according to in the Indian accounting standards 116. This is a non-cash gain. On the flip side, the company took a 5.6 5.06 crores of PPE write-off. Bluntly, this is the good news. It marks the end of a multi-year audit qualification regarding physical verification. The books are finally clean. However, the sustainable PAT growth is closer to 60%, not 99%. And if you see the net working capital, the net working capital days have jumped from 37 days in fiscal year 2025 to 69 days. So management says they are strengthening creditor cycles by paying suppliers faster. While this builds vendor loyalty, it is a massive drag on liquidity. So, and even if you see the cash conversion is currently ugly. In fiscal year 2025, CFO was 223 crores against EBITDA of 260 crores, which is around 85% conversion. With NWC spiking to 69 days, the divergence between reported profit and actual cash is widening. If net working capital days doesn't trend back to 45 days, this growth will eventually starve the company of cash. If you see some KPIs, average selling price is at around 363, which is an 6% improvement prior to the previous quarter, which is at 343. And average billing value is around 964 rupees, which is an up by 4%. And sales per square feet is nearly around 1032 rupees, which is down by 15%. And volume growth also grew by 48%. So the elephant in the room is 15% decline in sales PSF. Aggressive expansion, 35 stores in Q3 alone has diluted the averages. New stores simply don't produce like the old ones yet. However, we must be obsessive here. A persistent decline toward 900 rupees PSF would signal that V2 is over cannibalizing its own markets. So the normalized same store sales growth of 12.8% is the real number to watch. It accounts for the festive season timing shift and proves the core stores are still healthy. The unit economics are stable, but the expansion is currently masking the true velocity of the brand. And in November 2025, the company did a QIP by raising 400 crores. It signals that institutional investors have forgiven the Vishal era and are backing the current management's risk appetite. And management finally cleared the audit qualification hurdle with 5.06 crore PPE write-off. This is a massive de-risking event. However, the resignation of Sunil Kumar on February 9, 2026 creates a leadership vacuum. In high growth retail, people are everything. This minor resignation needs a high quality replacement or execution will slip. So credibility is very high but under pressure. The QIP monitoring agency report shows zero deviation in the utilization of the 39,999 lakhs war chest. They have the cash. The question is whether they have the management depth to handle 300 plus stores. Currently, if you see, the company is trading at a PE of nearly 56 with a price to book of 18.8 times with market cap of nearly 7,000 crores. So a price to book of 18.8 times is eye-watering. However, look at the 3-year profit CAGR of 101%. A price to earnings growth ratio below 1% actually suggests the stock is currently undervalued. Stock is fairly placed for hypergrowth, but make no mistake, at 56 times of PE, the market is pricing in perfect execution. Any miss in sales PSF will lead to a brutal re-rating. So it's overall, if you see the valuation is fairly priced. The stock isn't cheap, but 23% 23% ROE and triple digit profit growth justify the premium for now. We are paying for the future. If the future arrives late, the stock will get punished. That need to be carefully tracked by the investors. So key red flags in this company, which I found, are promoter dilution. Promoter holding dropped 2.79% in the last quarter. This appears to be dilution from the QIP issue rather than a secondary sale, which is acceptable, but any further drop is a red flag. And accounting complexity, there are 27.69 crores exceptional gains from lease reassessment masks the actual operational cost of the stores. And inventory risk, inventory days are at 111 days. In value fashion, inventory older than 90 days is where profits go to die. And capital allocation, the 6 crore impairment of a subsidiary investment is a reminder that not all of management's bets are winners. If you see a basic SWOT analysis of this company, 48% year-on-year growth, year-on-year volume growth, 92% full price sales, 23.3% ROE indicates capital efficiency are the key strengths. Coming to weaknesses, 15% decline in sales PSF, NWC spiking to 69 days, which creates cash flow drag, and high geographic concentration in Bihar, UP are some key weaknesses for this company. Coming to opportunities, unorganized to organized shift in Bharat in tier 2 and tier 3 cities. Ladies were scaling up margin expansion potential, and 400 crore QIP cash for footprint expansion are key opportunities. Coming to threats, inventory bloat of 111 days leading to markdown, and intense competition from Zudio and other value players could be a serious threat. And execution risk from senior management turnover is also a threat to watch out. So, what are the some key monitorables which we need to track? Or normalization of sales VSF, the targeting a return toward 1200 as new stores mature, and net working capital days reduction, monitoring if it trends back towards 45 days. 69 days is unsustainable for cash flow. And QAP fund deployment, quarterly checking on the remaining 399 crore cash balance and its return on investment. And same store sales growth stability, ensuring it stays between the 10 to 12% range consistently. And key employee replacement, who will be replacing the Sunil Kumar is need to be watched out. And inventory liquidation, tracking if the triple 1 day inventory cycle begins to contract. So core thesis, V2 retail is a high octane bet on provincial India's fashion upgrade. The model is proven, but the current valuation demands flawless execution as the company sprints towards a 400 store footprint. Hope you like this video. If you like this video, please do like, share, and subscribe to my channel, Murthy Finance Academy. If you have any questions, please drop a comment. I will try to answer them. And every day from now on, I'm going to post some important updates in the community tab. Please do track it. Whichever companies I'm unable to cover, I'll try to cover them in the community post. So hope you like this video. If you like this, please do like, share, and subscribe. Thank you.